Yes.
local. How do you see the Chinese economy, Bill?
I think we in the West often characterize China as suffering from
I think you need to hold the mic a little bit
the
closer.
three daunting Ds, right? You have dismal demographics, daunting debt, and deficient demand. And all of that, I think, is tied up to the property markets. You're absolutely right. But the one thing that I want to emphasize is that everyone says you need to do more fiscal policy. And if you do more fiscal policy, that means you got to spend more, issue more debt. Trouble is, the local governments are so indebted now. Their official debt is about 35% of GDP. The unofficial debt, the local government financing vehicles, is about 45% of GDP. So there alone, you're almost 100% of GDP. And the Maastricht, right? When they created Maastricht and the euro area, they said keep debt to less than 60% of GDP. So China, even on the local level, not even counting the central government, is so indebted it cannot do the needed fiscal policy to push up demand to get you to 5% growth.
Now, Martin, in Latin America, China has enormous quantities of debt to Latin American countries, and China is very much engaged with Latin America. If China gets a cold, if China has problems, is that going to impact Latin America, or is it kind of safe?
Well, Latin America has two key variables that is very much dependent on. One is interest rates in the US, and the other is commodity prices. In terms of the opportunities that you have, fortunately, we are on the verge of a commodity boom that is not based on what happened at the beginning of the years 2000, which was the industrialization of China. That led to a lot of very strong demand for industrial commodities and agricultural commodities. Now there are three key trends in Latin America that are going in our direction. One is energy transition, the second one is energy security, and the third one is food security around the world. The demand in terms of green energy and the demand for energy transition is going to be so strong in the next decades. This is not a question of just one decade, but clearly when you look at, for example, the lithium triangle down in South America, which is composed by Chile, Bolivia, and Argentina, it has a relative advantage, for example, relative to Australia. In Australia, you extract lithium from rocks. In this golden triangle, you extract lithium from salt sort of flats where you evaporate the salt. So clearly there is a competitive advantage in salt, in lithium, in copper. In copper, we provide almost 60% of world copper, and as you know, lithium-ion batteries basically carry lithium and carry copper and manganese. So although China is very important in terms of what it's providing as a source of demand, it is not the only source of demand, and there are these three key megatrends that are going on in the world. Not only, I say, energy transition, the green economy, but also energy security. And you have, for example, LNG, natural gas, which is one of the critical elements in the transition. We won't have green energy or hydrogen energy. It's costly, and one of the key transitions could be done by LNG, by liquid natural gas, which is provided, for example, from Mexico down to Argentina. Argentina has the second largest basin in shale gas in the world, which is called in Spanish, vaca muerta. It's not a good name in English.
That means dead cow.
Dead
Spanish,
cow.
yeah.
I would say it's a cow that is very much alive because it's producing liquid natural gas. And for example, one of the big investments from Asia in Latin America is Petronas. Petronas, the Malaysian company, that is projecting a pipeline coming from Vaca Muerta down to the Atlantic and producing a liquefaction plant to export not only to Asia. To Asia, exactly. So
you say Latin America is not dependent upon China so much.
So it is China dependent, but not so much. There are these three forces that are now in the world, again, energy transition, energy security, and food security are providing other sources of demand rather than China. And interest rates, it's another important area because Latin America is dependent on flows, on capital flows from the rest of the world. So lower interest rates will mean more flows, not only to Latin America, I would say to all emerging markets.
Well, let me stay with you just for a minute, Martin, because you used to be a central banker. Now I'll get to you, Bill, in a minute. The American economy, while we are here at this debate stage, we have Donald Trump is talking to Kamala Harris in Pennsylvania. I think I will be leaving this stage to go watch whatever happened there on the video. What do you think is going to happen to the American economy, depending upon who wins, and where is the Fed in this whole story?
Well, I think that the Fed is much more critical than the American economy. And let me give you a biased answer.
If you could hold the microphone a little bit closer.
Yes, a biased answer as a former central banker. The Fed, in my view, got it wrong at the beginning of the pandemic. I think one of the biggest mistakes in political economy in history was calling inflation a transitory phenomenon, in particular in the US. And this came out in the FOMC, that is in the report of the Federal Open Market Committee. And as you've seen, again, it was an unprecedented shock to the world economy, but the massive inflow of monetary policy, the massive inflow of fiscal policy, all done together was a critical element that never happened before. Also, because we were all in our houses and we were all confined, this amount of money was basically channeled into goods and not into services. So we had that concept that all this flood of money, helicopter money that we had from fiscal push, the Treasury giving out checks to all people that were in their houses, to many companies, unfortunately, that were paper companies. So we had clearly a great fiscal expansion with a monetary expansion at a greater speed, at a fantastic speed that we've never seen before. So inflation was a natural cause that the Fed didn't catch at the beginning. I think they were too late to the game. What we've seen is phenomenal in a short period of time. In 12 months, we had a rise from 0 to 5.25%. It is unprecedented. We have to look to the decade of the 80s to see that kind of rise. And that has hurt the American economy in terms of the recovery. My point now is, will the Fed get it too late at this point, in terms that the key question in the US economy is the slowdown. And the slowdown that we have seen in the labor market, for example, if you look at the July meeting of the Federal Open Markets Committee, there you had already that the labor market was clearly with quite a slack. 2 days before, we had the increase in unemployment from 4.1 to 4.3%. The Fed met and it didn't move interest rates. In my view, and they should have done it at that point, and now they are running behind the curve in terms that the key risk for the US economy is not only a slowdown, but also a recession. My point is that probably the US Fed will react. We are in an electoral period. We will see at the next meeting of September 17 and 18 of the FOMC. My point is they should start decreasing interest rates at around a rate of 50 basis points, probably because they are running behind the curve. But most important, Mike, is not only what they do in September, but also forward guidance. As a central banker, it's very important that you give the private sector where you're going, the horizon. So it's very critical that the Fed comes out with a forward guidance of what are the next steps. In my view, what the US needs at this point is at least 100 basis points coming down of the interest rate.
And Martin, just to be clear, a basis point is 100. So when you're talking about 0.5% or 1%.
That's right.
Bill, how do you
thank you for the
see
clarification.
Yeah.